Okay.
I think we hear you just fine. And good evening, everybody. Okay, so Dana's going to go through what happened in the news this week. We're certainly going to talk about Apple. We'll talk about some of the other stories that happened this week. We'll go through Rosetta and look at their most recent financial statements. Do that problem at the end of Chapter 10, and then we'll jump into Chapter 8. So any questions before we get started? Dana, it is all yours.
Okay, thanks. All right, so I'm Dana. I'll be doing the review of the week for last week, March 18th to the 22nd. So I'll start with the U.S. markets overview. As you can see on the chart to the right, equity stocks were rising a bit during the week and then fell on Friday, along with U.S. Treasury yields and oil prices due to growing anxiety about the health of the world economy. So there have been several signs that the major economies may be slowing down and could be entering a downturn. So one of those, on Friday, a report showed factory output in Europe fell the most rapidly it has in the past 6 years. And in addition, U.S. manufacturing activity slipped to its lowest level in nearly 2 years. So in result, the Dow fell 1.8%, S&P 500 fell 1.9%, the NASDAQ declined 2.5%. So it's also important to note that the stock equivalents in France, UK, and Germany also saw a loss last week, showing that this could be a global issue. Much of the anxiety around the economy is about whether central banks' wait-and-see policy approach will be enough to avoid an economic slowdown. So the Federal Reserve this past week has taken this wait-and-see approach, and it announced that it's holding rates steady, and likely it will hold rates steady throughout all of 2019. So this decision has pretty much split the market into two. Some people believe it's another sign that the world economy is slowing, and others think this decision to not raise rates could prolong a healthy market. So I just wanted to open this question up to the class. Do you guys think that the Fed holding rates steady will be enough to overcome a downturn, or do you think it's more of a warning sign for a more persistent downturn?
Any hands? Given that hands aren't going up so fast that I can't track all of them, Dana, why don't you call on somebody? They really like that.
All right. So, I saw Jordan has his hand up.
I don't know that we can say right now whether or not it means anything, to be honest. I mean, rates have kind of ticked up. Personally, I think rates have ticked up kind of quick to where they're at now. I guess at some point in time we had to get off the real rock bottom low rates, but I think people kind of got accustomed to that. So I don't know what to make of what the rates are. I can tell you in the line of business that I'm in that it's I don't see any signs of a slowdown, but that's just one line of business. So that's my 2 cents.
Okay.
Jordan, remind us, what line of business are you in?
Consulting engineering.
Okay. All right. So engineering, and that's a pretty good indicator because engineering leads a lot of the activity. So if you guys haven't slowed down, that's a good sign that that industry is still thinking we've got a pretty robust economy.
Great. Anybody else have a hand raised? Doesn't look like it. So we'll move on. So next I'm going to cover the major news events. So we'll start with the ongoing discussion about trade deals between the U.S. and China. The U.S. has pressed China to buy more than $1 trillion in U.S. goods and services as part of the deal. But U.S. chip makers have told the Trump administration that they don't want any part of this. So because U.S. production costs are so high, this forced demand of $1 trillion would cause U.S. chip makers to potentially have to open factories in China. So this would give Beijing more control over U.S. firms, and this would benefit Chinese competition and make the U.S. firms more dependent on China, which these companies ultimately fear. They want to stay free from that control. Next, I'll talk about Disney closes a $71.3 billion deal for 21st Century Fox assets. Disney will now control Fox's production studios, as well as its cable network and National Geographic properties. Does anybody have any ideas as to why Disney is merging with Fox? Any hands? Tom?
Yeah, it's kind of interesting. I guess what they're trying to do is compete with streaming services, such as like Netflix. And then I'm not sure if you're going to talk about it later, but even Apple today announced about having Apple TV Plus. So it's like, everybody's trying to get in on jump on the bandwagon with all these streaming TV and services and things like that.
Yes, that's exactly
Right?
correct. Yep, exactly correct. So the combined entity is part of Disney's long-term strategy to release a streaming service. And actually, they're planning on coming out with that later this year to compete with Netflix. And I don't know if anybody's noticed, but Disney has actually already started removing its movies and television shows from Netflix to prepare for that jump, which I found was interesting. So next, a jury found that a man had developed cancer from exposure to Bayer weed killer that he used in his yard for years and years. This is the second case to go to trial. So Bayer faces over 11,000 lawsuits claiming its products cause lymphoma and other types of cancer. So it's not surprising that their share price dropped more than 12% this week. And also, what might not be surprising is Bitcoin is in its longest slump of its 10-year history. So additionally, the total market value of all cryptocurrencies is currently down 85%. So they've struggled to attract mainstream investors, and also regulation on those is still pretty unclear, which has scared a lot of people off as well. So the severity of this recent drop is causing people to believe that Bitcoin might not recover. So the market's long-term success now relies more on developing an actual tangible use for Bitcoin and how they're going to market that going forward. And the next story I came across was two large drug maker companies, Biogen and Eisai, say they would end two late-stage studies of a once hopeful drug after determining it would not be able to help with Alzheimer's patients. With Alzheimer's patients. And so both of these company stocks clearly took a hit after this, with Biogen shares down 29% and Eisai's down 35%. Biogen lost about $18 billion in market value after this announcement. So these companies, they're taking quite a large hit. This was pretty. People had hyped up these new drugs, so it's not looking good for them. But also a little bit more on depressing news.
Oh, hold on. Don't leave this story yet, Dana. This is
Okay.
a big one for a couple of reasons. One, the drug companies are saying, this is why we charge so much for our drugs. Here's a drug that we've worked on for many years. We've spent $18 billion, billion with a B, and we're going to get nothing out of this research. That's what we do. That's why drugs are so expensive. The other thing that's important is one of the things that we can talk about in projects is real options. And real options say that the value of the project that we calculate when we do an NPV actually may be worth a bit more if we have the option to pivot as we're moving along. So the ability for Bayer and Eisai, I think is how you pronounce it, to stop this drug production and call it a loss and a sunk cost and move on, rather than continuing on through phase 4 trials, rather than bringing it to market and having injuries to people, is an option to abandon the project, and that creates additional value. The challenge you have when we talk about options embedded within projects is that very frequently companies will claim they have the option to abandon, but they won't do it. And so this was actually a pretty good sign that these two companies said, this isn't going anywhere. We're going to stop this right now and stop pumping money into this project and risk hurting patients in the future. So it was actually a good thing that they stopped. It was a costly thing that they stopped, but most of the Alzheimer's drugs thus far have been have really been challenged to be effective, and as a result, there was a lot of hype for this particular drug. And now that they've stopped, you saw both companies' stock price drop. Would have dropped even more had they continued on, though. Okay, sorry. Go ahead.
That's okay. I just have a quick question. Do you think that a lot of investors, they overlook that, so they don't necessarily see them abandoning it early as a good thing, as opposed to?
No, I think most investors see it as a good thing when you abandon, because if you continue on, you're just dumping more good money after bad, and that's not a good option. And an unethical company might say, well, let's get it on the market and factor how many people might be injured and what the cost of those lawsuits would be versus the value in marketing this drug, and that's a bad thing. So from an ethical standpoint, this is a really good thing that they stopped at this point rather than continuing on. And investors just, by the time you get to phase 3 of drug testing, most of those drugs are going to continue on. So investors had really started hyping the fact that this was going to be a huge win for Bayer in terms of producing this drug. And then once that opportunity fails, then the stock price is going to pull back, as it should. But had they continued on to phase 4 and then stopped, or continued on and injured people, you would have had a much greater pullback further down the line, but it would have been a greater pullback. So it was a good, it's something that companies are really bad at, because, the manager of this project, he didn't want to stop this project. He's got a project that he's going to get all kinds of bonuses for getting this thing out there. And the CEO doesn't want to have to admit and have that stock pull back. So it's really tough for companies to abandon projects once they get going. Even if at some point they realize it's sort of tepid and it's not going to be worthwhile, they just aren't very good about pulling back. And a couple of the companies lately have been good at it. Who am I thinking of that? Amazon is extraordinarily good at starting something and then saying, never mind. They just did it with their retail outlets. They're pulling back on their current retail market models and they're going to do something else. So they have been very good at abandoning things that are not hitting the numbers that they expect. But most companies just are not. They ride products way too long and end up destroying more value than they should have.
All right. Good to know. I kind of, I guess, viewed it the other way. So that's definitely good to know. So the next story we have here is a bit more news on, I know we had talked about the past few weeks, the Boeing crashes. So as we all know, Boeing is facing its worst crisis in years after these crashes. The plane is currently grounded in most countries, and some airlines are beginning to rethink their orders. But actually what made headlines was the fact that an Indonesian airline actually had this plane ordered and canceled its order for this plane. So, this is coming to headlines because it's important to note that if there is a major slowdown in Boeing's business, this could affect the entire U.S. economy and greatly impact GDP. So this is definitely something that I think we need to look for in the near future and keep an eye on.
Can I say something?
Sure.
Sorry. Yeah, so an interesting thing that I just heard today about this Boeing is China is just on the verge, and they may have already done it, signed a $35 billion deal with Airbus. And, instead of Boeing for the planes. So, assuming that they were going to buy Boeing jets, the Airbus, I think it's an Airbus 320 is a competing airline with the Boeing. So $35 billion they could have, they just lost due to this, mess up or these two crashes, I guess. So anyway, I just thought that was interesting that China just announced that today.
The cost of this blunder just keeps growing. This is a big one for Boeing.
Yeah, I think it's, that happens, then it's not necessarily, you see the effects all at once. So it'll be interesting to kind of watch that story as time goes on. Definitely. So the next story, also that it's been kind of an ongoing thing, is Facebook has been scrutinized, as we know, for much of the past year over data security issues. So recently it came to light that for years, Facebook stored hundreds of millions of user passwords in a format that was accessible to its employees. It doesn't appear that any of this information has been abused, but since passwords, as we all know, we often reuse many of our passwords. Since that occurs, this is highly sensitive data. So you can imagine how maybe other sensitive data might also be mishandled there. However, even with all the negative press, Facebook revenue still soared 30% in its last quarter. Does anybody have thoughts as to maybe why they're still doing so well? There's no right answer, really. I just know that, we all use Facebook, and just kind of some insight into that. Mallory?
I think that people don't realize, I guess, like how far their reach goes. Like I've seen people like, oh, I'm not going to use Facebook. I'm only using Instagram now. But it's like the same thing.
That's definitely true. I also think, Max?
So like I know that at least through like my iPhone, a lot of the games and things are also linked to your Facebook account, and I wouldn't be surprised if Facebook's actually getting a little bit of a revenue stream from kind of marketing some of the video games and things on your phone. So essentially, like if you do an in-app purchase or something like that, I wouldn't be surprised if they're getting 2 or 3 cents on the dollar just for being able to provide that advertising. So I think that's kind of another way to see revenue grow. Not necessarily having to do with privacy, though.
Well, I mean, a lot of the new apps that you have, a lot of times you'll see that option where it's, either create an account or just link it to your Facebook. And I think that it's such a convenient thing that people aren't really focused on a lot of the security issues. It's just kind of become habit.
Dana, Cindy's got her hand up as well.
Oh, okay. Cindy?
Mic on, Cindy.
Can't hear you.
Can you hear me now?
Louder. Turn up your volume a little bit.
Oh, okay. Try it now.
It's better. Just talk really loudly. It's still very soft.
Okay.
Just yell at us.
I think for the most part, unless Facebook users are directly affected by this data breach with their passwords, they're just going to continue to use it. Mainly because it's become so popular and so many people are they're addicted to it. So they're not going to stop unless it directly affects them.
Yeah, I agree. I think, I also think, yes, it's convenient, and it's just become one of those things where people get used to the fact that, oh, it didn't happen to me, so it should be fine, and just kind of overlook it and keep moving.
Did anyone notice an Apple commercial this weekend? It may have been on sooner, but I only noticed it for the first time this weekend. Anybody see a new Apple commercial in the last couple of days?
I think I saw Jordan with his hand up.
Jordan, what'd you see?
Talking about the one with privacy.
Yeah. So talk
It's been
about
around
that
for like
commercial.
2 weeks.
Oh, has it? Okay, I only saw it this weekend, NCAA games.
Yes, they have you want me to talk about it?
Yes,
The
please.
commercial is basically just it's like a bunch of different flash images of like locks, and basically the whole gist of the commercial is that Apple's trying to say that their phone and their the iPhone XR, I think is what the actual ad is for, is what's that? The tagline is like, if your life is on your phone and privacy is what matters most, the iPhone is about having the most privacy, or having control of your privacy. Something to that effect is basically what they're saying with that commercial.
Why do you think that's out nowadays?
I don't know. Personally, I've never been on any social media, Facebook, any of that stuff. So I don't get that. I use my phone for business and for making phone calls and text messages. I have no idea why people are on that. Like, I don't have time for that. So I can't really answer. Privacy to me is don't put your stuff out there, and then you don't have to worry about it.
Okay, fair. Anybody else? Why do you think the ad's out? I think you're starting to see the convergence of these different industries. And you see Apple today coming out with their new streaming service. That's a direct take on pushing back on Amazon and on Netflix. And I think you're also going to see Apple into some of the space that is currently Facebook and Instagram. Yeah, they're positioning themselves, which if they don't have a data breach, is a nice position to be in if people take their privacy seriously. And I sort of agree that in general, with Cindy, in general, we don't really think about it until we're affected, and then we're annoyed for a little bit, and then we sort of forget about it and go back to our old ways. So I think it's an attempt to fight some of these, to set themselves up as superior to some of these companies that will be their competitors in very short order. There's a whole lot of convergence in some of these industries right now. Okay. Yeah, you're up.
All right. So, and last for current events, I'll just talk about two IPOs that are creating some buzz right now. So first, there's Lyft, whose valuation is somewhere between $21 and $23 billion, and the IPO will be between 62 and 68 per share. Lyft is valued far higher than its last private valuation, which was about $15 billion early last year. However, it lost $911 million last year. So Lyft should be on the market sometime this week. But I just wanted to ask a question. So investors are, so I've been kind of reading up on this where people recommend, should you invest into Lyft or should you wait? Or a lot of investors are talking about they're hesitant to buy into Lyft as it becomes available. But they say that they would likely reconsider it maybe in the next 5 years or so. So does anybody have any insights as to what might be interesting them in 5 years that might not be interesting them now in companies like Lyft and Uber? Mallory?
Is it that they're hoping that we would have self-driving cars in a better place by then?
Yes, absolutely. So they think that Lyft is a good stock option, but will reconsider it about the next 5 years due to, the success that they hope that these companies will have with driverless cars. So right now the costs are pretty high. So when driverless cars will come out, those costs will minimize, and that's when the company will really start making money. So that's what investors are really looking for. And next we have Pinterest, who sped up the timing of its IPO and is preparing to make the filing public in the coming days. The company was last valued at $12 million, but like Lyft, Pinterest also has a history of losing money and actually lost $63 million in 2018. However, they're trending in the right direction. I think they lost about like 160 the year before. So that's something to look at. And then looking ahead.
Wait a second, before you look ahead, that Pinterest IPO is interesting in that their financial information, when you take a company public, one of the things you do is a roadshow. And so you put together a prospectus, which for the first time for these privately held companies, their financial information is available to the markets. And when they have done that, getting ready for their initial public offering, what investors have seen is that they're not really good at holding on to their customers, that some come in periodically. You need a recipe, you go to Pinterest, and you may not go in there for another 6 weeks or something. And that most of their customers are not purchasing there. So they talk about Pinterest as sort of a new search engine because of the volume of material that's in there. But people are not going in there and buying things, which makes it difficult to monetize. Despite the fact that the numbers don't look great and the prospects don't look great, this is a perfect example of the market gets kind of frothy, getting ready for an IPO. And so others quickly join in to kind of ride that IPO wave, because IPOs do occur in sort of chunks of IPOs. It wouldn't surprise me at all if before the spring is out, we see a couple of more of the unicorns or some of the bigger companies go public. Especially when you saw Pinterest results that were not good and they still said they're going forward, that's a sign of a pretty frothy IPO market.
I think, Jordan?
Yeah, going back to your Lyft investment question, I don't know if this was the same article that you're referencing, or I read something in the past couple of days where there is a shift in the in the millennials and the younger generations to away from actually owning a car, and that's also kind of where people are waiting to see just how much of that a bandwagon, whatever you want to call it, how people are jumping on. But you know, there's a generation of baby boomers who are getting out of the car, the need to have a car. You know, they're aging, and then you have another generation or several generations that aren't finding the same type of needs from a car perspective. So there's there could be a huge uptick in people just using Uber or Lyft as their primary car service and not actually making a car payment or owning a car.
Absolutely. I did not see that article, but I mean, it definitely, it makes sense. And also living in, big cities where maybe people rely on public transportation, or cities like Baltimore, where most of us do need a vehicle now that these services are here. We might not. If you weigh out the cost, it might be comparable. So
that's what this article was about. Actually, it was about whether or not owning a car was cheaper than using Uber / Lyft, and I think there's another service that they put in there as well. And it turned out that it was cheaper for them to not have a car. With the insurance and the cost of a car and maintenance and all that he factored in, I think he was saving like $250 a month.
Wow, I don't want to hear that.
It's interesting. I have a niece she's 25 and is married, and they don't have a car. They live in Arlington. They both work in DC and take public transportation. And if they're going out of town, they rent one for the weekend. And she swears it saves between the two of them at least 10 grand a year. And she's not at all inconvenienced. If
Wow.
more people follow that track. Now it's limited because you have to live in urban areas and you have to live where there's decent public transportation. But there's a lot of cities where that qualifies. And when you think about what you pay in parking and such, you can see why it makes sense.
Absolutely. And I think that a lot of people never thought about that as an option. So now, once somebody gets the ball rolling, it, really might open up the door for that kind of thing. So, can't remember where I was at. Okay, so looking ahead. So I'll start with looking ahead at Brexit. European leaders decided to allow the UK Prime Minister to postpone UK's departure past March 29th. So the deadline originally was sometime this week. Since it depends on the deal made by the next deadline, it's currently kind of uncertain how Brexit might affect the European or the US economy just yet. So we'll have to look for that in the near future. Next, we have the ongoing trade talks with China, which I had mentioned earlier. Stocks fell midday Wednesday after President Trump said that tariffs on Chinese imports will remain until China complies with an agreement. So we'll see in the near future if this will happen. But I know that we've been talking about the U.S. and China trade deals for a while now. So we'll see if that happens anytime soon. Next, Walmart is using JetBlack, a personal shopping service, to compete with Amazon. So several hundred shoppers in New York City pay $600 a year to order anything by text message, and it's delivered the same day. So the project is currently losing money. And when I got this far in the article, I thought, this is ridiculous. Why would this ever compete with Amazon? But actually, it's part of a long-term strategy. So the idea is to train an artificial intelligence system that could someday power an automated personal shopping service, ultimately to rival Amazon. So this is something that's kind of been creating buzz, and we should keep an eye on this. But most likely, if this is successful, we really won't see its effects for quite some time. And then last, which Shai had touched on earlier, should we expect a recession? I think we've kind of concluded that we really don't know either way, but I just kind of wanted to weigh in, and say that opinions seem to be split on whether or not we're headed for a downturn. So some who say the market will push through argue that corporate earnings, like while they're slowing, are still expected to grow. The labor market has added jobs for 101 consecutive months, which is the longest streak it's ever had. And unemployment is still very low. But those who think a recession is unavoidable say that slowdown in Europe could have a ripple effect on the US economy. And the Fed might actually go as far as lowering rates. Some people do think, which hasn't been done since the financial crisis in 2008. So there's a lot of speculation, and it's hard to tell either way. So looks like we'll just have to wait and see. But if anybody has any comments on that or any questions at all. Mallory?
Sorry, I'm like full of questions today. So I don't know, I mean, maybe it could be related to the recession, and I think it's more of a question for the professor. So I saw that I think it was Germany and Japan, their bond rates dipped below 0. So they had like negative percentage on their bond rates. So maybe that's like something that we could talk about when we get to bonds. But I guess, like, how does it make sense to have a bond at a negative rate?
Yeah, well, it's because their markets are struggling. So you're seeing such demand for bonds that they're able to lower the rate down far enough that you're actually paying to invest your money. And it's a small, it's just a few basis points. So it's a very small number. But Germany particularly, they came out with bad manufacturing numbers. And you're starting to see a bit of a recession in Germany right now. Other than the US and China, Germany is the next largest trade partner globally. They're impacted certainly by Brexit, but in general, they're just being impacted negatively right now. So there's some concern that Germany could lead the rest of the global economy into a recession a little bit faster than people are expecting that we're going to get there. So yeah, the bond rates can turn negative. Did anybody see what happened in the US on Friday with bond rates? Yeah, what happened next?
So there was an inverted rate, meaning that it was a 3-month bond actually was not rated more highly, but you were gaining more of a return than the 10-year, which was kind of interesting. So it meant that you're actually earning more money by investing in a shorter, maturity rate bond.
So a typical yield curve slopes up for ratings. And so the short-term bonds tend to have a lower interest rate than longer-term bonds. And that makes sense because in the short term, the likelihood that you don't get your money back is pretty small. And over time, inflation factors in, and we expect, because we're not going to get the use of that money for a while if we're invested for 10 years versus 3 months. 10 years, we tie up our money for 10 years, so we would expect to earn a higher return, even on equivalent risk, because our money's tied up, so that's an opportunity cost. We don't get the use of our money, and inflation occurs during this period of time, so our money won't buy as much 10 years from now if we have positive inflation. So typically what you see is an upward sloping yield curve where the yield on short-term government bonds is lower than the yield on longer-term government bonds. On Friday, and I believe it's switched back now, on Friday briefly, the longer-term bond yields fell below the short-term bond yields, and that typically is a signal that we're heading into a recession. So the last time it did that routinely was in 2007, so about a year before the recession. So when the yield on the long-term rates is lower, it typically means people are concerned that we're headed into a recession. So it didn't last long, but the yield curve is pretty flat right now, partly because interest rates are so low, partly because inflation is low, partly because people are a little concerned about a recession, especially what you're seeing with the manufacturing numbers, not just in Germany, but in the US. They have been a bit down. And that's why the Fed's really backing off, and not only backing off of future rate increases, saying we may not have another rate increase the rest of the year, and we're pretty early in the year, but they're also talking about maybe cutting rates usually a sign that they're a little concerned. I saw a good Barron's article. I think it came out on Sunday, and it was talking about the Fed in essence is acknowledging they made a mistake by raising rates too quickly. So there's a little bit of a pullback from that. So according to the yield curve, Dana, there's a chance that we might be heading into a recession sooner rather than later.
All right.
I don't believe it.
All right. And that was everything I had.
Good. Anybody else have anything else? Germany I want to talk about. I think you hit all of the big ones. I did see Kroger's results disappointed, and then I loved seeing Lululemon. One of them said, "Oh, Lululemon's doing better than expected," and then another one came out and changed their ratings on Lululemon and said, "Oh, yeah, their margins aren't as good as expected." So depending on who you believe, Lululemon's great or they're not so good. So either way, make your investment decisions accordingly. And then Apple was the other one. Did anybody else see anything on Apple or find anything interesting in the Apple story that came out today, what they're planning on doing? Yeah, I haven't had a chance to dig into it deeply enough to really have a sense for what's going on, but I'm anxious to see what the results look like. In general, from what I saw, I was surprised to see them move so heavily into shared services as opposed to anything with a physical product. But that space is getting really competitive, and Apple has been known for these innovative new products, and it doesn't appear quite so innovative at this point. Okay, I think I said we'd do Rosetta next. If you would go ahead and complete Dana's evaluation. I think this is the first time this semester I remembered to say that. This is just amazing. And then we'll do the chapter 10 problem, and then we'll do Rosetta. So I pulled up those slides first. Okay, and Mike Cook, are you able to speak to talk about how you went about doing the chapter 10 problem?
Sure. Can you hear me all right?
Hear you just fine, yes. Are you on phone instead of on your computer?
Yeah, my computer is not compatible with Zoom for some reason.
Oh, sorry. Well, you're nice and clear. That's a good sign.
Perfect.
Okay, Mike, go ahead and tell us what you did.
So did you want me to share my screen or just kind of talk through it?
Yeah, let me go ahead and give you permissions to share. Okay, I just stopped my share, so you should see a toolbar at the bottom that allows you to share your screen.
Okay. My entire screen. Okay. All right, so can you guys see my Excel screen?
It's still thinking.
Excel,
so it is trying, so you should be popping up. There you go.
Okay. All right, so you can see my screen now?
Yes.
Okay. So I just started initially with just figuring out, we'll go through the profit and loss statement in a second, but I just wanted to first tackle the upfront year zero capital expenditures and then the related asset sales, because there was the maker schedule and I just wanted to get that out of the way. So just kind of going down my screen, in year zero, the first cash outflow is the CapEx, the fixed asset, for $19.5 million. And then so what I did was I plugged in that into the maker schedule, and these were the first 5 years of the maker schedule that we received, and basically just calculated what the total asset value is multiplied by that for each of the upcoming years, and just kind of multiply that out. And what that came to was an accumulated depreciation number. And the reason that this is relevant is because the asset value that you're holding on your books is at the end of 5 years is going to be different than what it's ultimately sold for at year 5 on the cash flow forecast, which was 20% of the original purchase price. So you're selling it at salvage value at 20%, which is $3.9 million, which is actually a loss on the sale of the asset. relative to what the book value, or I guess the book holding value would be, which was this $4.3 million. And so what that ends up doing in year 5 when you go to sell it is that creates an income tax benefit, applying this difference of $450,000 at the 35% tax rate. And so just kind of going back to this CapEx line here is in year 0, you have 19.5 million as an outflow. And then when you go to sell that at the end of it, you sell it for 13.9 million plus you have $157,000 tax benefit that needs to be factored in. So that's just kind of the CapEx line. Any questions on that?
Stop there for a minute. Okay, what questions
Sure.
do you have about how we got to the accelerated depreciation schedule and the sale price, the cash flow from the sale of the asset and the tax credit? Any questions on that part? I'm not seeing any hands. Okay, I think you're ready to go.
Great. Okay, so then now that that's kind of out of the way, I just wanted to start with the income statement, ultimately gearing towards figuring out what the cash flow is, but starting really with the unit sales, which were provided, and then the average selling price, which was also provided, and just multiplying those two numbers together each year basically gave me my revenue number. And then if you go back to the depreciation schedule, I started taking out expenses, including depreciation. So I just pulled up from the depreciation schedule what my annual depreciation is. That's my first expense line item. Then I have my variable costs, which were $190 per unit. And so I just multiplied all of those costs over at that rate. And then you have your fixed costs, which stays the same for every single year, which is just held out as a constant. So I have my total expenses, which are adding up depreciation, variable costs, and fixed costs, where I get to my earnings before taxes, or I guess my EBIT, but interest isn't really playing here. So earnings before taxes, or your taxable income, is your revenue minus these expenses. And then you have your multiply that by your 35% tax rate, which comes up with you get your net income. And then down, just keep going down just to get to my operating cash flows. I start with my EBT. I add back my depreciation, subtract the taxes, and that becomes my operating cash flow for each year. And then I have to factor in, to get to the actual cash flow, I have to factor in the working capital. So it was an upfront working capital requirement of $1.5 million, which is in year 0. And then the formula for calculating each year's working capital needs was 15% of the revenue change of next year's revenue growth. So I take my year 2 revenue minus my year 1 revenue multiplied by 15%. And I basically just drag that formula over for each year up through year 4. And then in year 5, I just reverse out all of those working capital, basically those working capital flows from each of the previous 5 years. And that's kind of like a true up at the end. So to really pull it all together, I have my operating cash flow that I just calculated here. I have my working capital, and then this CapEx, which is, I guess, your fixed asset purchases and sales. Not really CapEx, but and so I take all of those cash flows, add them all together, and then calculate my NPV with an 18% required return rate. So that gave me 8 million. Well, you can read the number on the screen. 8.4 million. And then also using the same cash flows, I calculated the IRR, which I could do because it was negative 1 year and then went positive for the remaining 5 years, which gave me a 33% IRR. So any questions, or Professor, did I miss anything there?
No, that was terrific. What questions do you have about the working capital numbers? Okay, so as Mike noted, in the early years, our sales numbers are growing, so our working capital is actually growing. I don't know why I'm all closed up there. So in the early years, your working capital is growing as you're growing your business, and because as we grow our sales, we typically need more raw material. So if you're increasing your working capital, that's a use of cash. So we have an initial use of cash to set things up. The first 2 years, because working capital is based on the increase between now and next year's sale. So we have an increase in working capital for the first 2 years, but then we start paying down the sales start declining, and so instead of buying raw materials, we start using out of the inventories that we have. So our working capital actually declines, which is a source of cash. And in the last year, we just sum everything together to zero it out. So overall, we had a use in cash through time. So we create a source in year 5 to put the company back to whole after this project concludes. So the fact that we that we built up working capital is great, but at the end, we want the company to be back to point zero, as if this project never existed. What questions do you have on that? Are you feeling okay about that problem? It's a tough problem because it's more realistic than most things that we have time to do in here, but it's a good problem.
Can we flip back to the Excel spreadsheet? I just had a question on that last year where the one number was coming from.
Mike, go ahead and put your spreadsheet back up so I don't confuse them by putting mine up.
And I think I know the answer, but is it the salvage value plus the tax break?
Yeah.
Okay. That's how you're getting to that like 4057?
Yeah, it's the salvage value of $3.9 million plus the $157,000 in savings on taxes.
Okay. And then I also have another question, since this one was a lot more complicated, and if you don't know how to do a depreciation schedule like myself, I feel like it was hard to figure out. Like, I think from a top part perspective, like that was fine because it was consistent with everything else. But I guess in terms of expectations for the final exam, would the expectation be that we would have to put together a depreciation schedule or know how to?
Okay. I give you 1 hour for the final. We typically have 6 to 7 questions. How long would you expect this problem to take you? Yeah. No, I can't do anything this complex on the final, but it would be absolutely expected. And really, maker schedules are more accounting than finance. They factor into finance, so you need to be familiar with them. But I typically will do something in straight line depreciation, so that you'll have to calculate a depreciation, but it'll be the same amount every year. And it would be very unusual that I would have something like this where sales are changing over time, because you would spend so much time doing basic math calculations that you wouldn't have time to do other problems. So no, this is a good real world kind of problem. It's not a good test question because it just take you too long to do this.
Okay, thank you.
But if you can do this, you can do anything else I can throw at you.
I also had a question. Mike, do you mind sending out your schedule in case we wanted to like look at the formulas and play around with it, just so we can familiarize ourselves with kind of how you thought through it? Would you mind?
Yep, no problem.
Okay, thank you.
And Jamie, I'm also posting this problem. I'll post the Excel file too, and I'll send Mike's around as well.
Okay, great. Thank you.
Okay. Okay. Everybody good on that one? All right. Let's take a couple of minutes and talk about Rosetta. I sent you the spreadsheet ahead of time, and I think it goes from 2012 to 2000. I think it goes, I gave you pro formas for 2019. Balance sheet looks like it's starting at 14. When's the, oh, I'm sorry, it's 14 forward. Give me your overall impressions of Rosetta based on what you looked at in these financial statements. Anybody? Clearly, you spent the weekend studying these financials. Ben, what did you see in the financial statements? Ben's now pretending his mic doesn't work. Okay, there you are.
I actually did not get a
Did
chance
look at
to
them?
look at
Okay,
them.
no problem. Anybody else have a chance to look at them and discover anything?
So I don't know how to like raise my hand because I'm on like the light version. But
Okay.
is that all right if I just jump in?
Yes, Mike, go ahead.
So it was more of a question. One of the comments that I noticed in when I did the write up on the case was that they were consuming a tremendous amount of working capital on their cattle, purchasing that, and that was kind of their business plan of building this herd of cattle, and that was costing them. But then when I actually looked at the cash flow statement, it seemed like, or the balance sheet, it seemed like they were continuing to keep their inventory pretty high, but then in some cases it switched back and forth between being a source and a use of cash.
Yeah.
And I just didn't see how that matched the actual balance sheet itself. And so I was kind of, or at least not to the magnitude that I was expecting, or the timing of it. So I just was kind of thrown off, especially like 2014, 2015. It looks like they purchased cattle, but then when you look on the 2015 cash flow statement, it looked like that was an increase of cash. So I was a little thrown off by that.
Yeah, the challenge with cattle is that they're so subject to the pricing of cattle, and you saw a big decline in the price of feeder cattle that they're buying. So that's what's impacting their inventory numbers. They're continuing to grow their supply of cattle so that they can meet the demand that they have to produce steaks. But the price of the input, the price of the cattle dropped, and so when that dropped, it impacted their cash flow numbers and certainly their inventory numbers as well. Anybody else notice anything on the cash flow statements or income statement? For a number of you on your cases, I commented that you did a nice job of keeping your discussion of the financials pretty brief, because really there wasn't anything overly remarkable about the financial statements for Rosetta, mainly because you noticed the negative equity, and we had talked a little bit about that, but there's nothing terribly remarkable. I think the same can be said today. So what you have is you have a company that has continued to grow its revenues, much like it said it was going to do. Their margins are good and strengthening. So their revenues relative to their costs are actually getting a little bit better. They did turn cash flow positive. They did get positive cash flow from operations in this year, OG. So their cash flows did turn positive, which was good. They in 2015. If you look at the pro formas, you can see they're looking to be at 19 million by the end of this year. We'll have to check with Eddie, but I believe his number is 22 million. I think 22 million is where they need to expand their fixed assets for the next jump in capacity. It looks like their veal and lamb productions are still, several of you mentioned, not great margins on those numbers, and it looks like that's continuing, although it looks to be a shrinking portion of their business. So it may be that they are processing lamb and veal when they have additional capacity within the plant, but as they no longer have capacity, they may be reducing their exposure to those products. So in general, I thought they look certainly better than they did each year, and nothing was terribly remarkable. I'm always happy to see when margins are improving. That's a good sign. That's a good sign of some cost control. They did have a little bit of a dip in 17, I think. Is it 17, 18? Let's see. Yeah, their revenues dipped one of the years. Total, let me get down to the total revenues so I can see it better. 14, 17. Yeah, between 15 and 16, and again in 17, they had a little bit of a revenue dip, Most of that was not due to their beef. Their beef actually continued. It went down slightly in 16-17, but they had a bigger dip in their lamb, and something else dropped a whole lot. The lamb offal dropped a bit in that time period too. But in general, you have the financial statements now, which you have access to and can reference as you see fit for your final projects. In general, they're continuing to do pretty well. They're growing at about the pace they wanted to while maintaining their margins, and have turned a positive cash flow from operations, which is a good sign for the company. All right, any questions about Rosetta? Anything else that you noticed in there? You have plenty of time to look at this. But I would suggest before Eddie comes to class, which for your class is April 10th, I believe. No, 15th. I think it's April 15th. So before he comes in, you definitely want to look and see if you have any questions about anything in here, so that you have the ability to ask him directly to help with your project. Good? All right, let's time to say, oh, we're in great shape on time. All right, let's take a look at Chapter 8. Chapter 8 is the beginning of how we think about valuing stocks. And okay, so if we think about undertaking a project, the problem that Mike just worked on with us a few minutes ago, in deciding if we want to do a project, what do? Well, we do pro forma statements, and then we figure out what the cash flows are going to be each year, and whether or not we want to do the project is based on what the cash flows are today. That last project had an IRR of 33 million and a positive 8 million in NPV, so that's a good project. Well, with a stock, what's the cash flow that you get that's associated with stock? Adam, what's your cash flow for stock?
It would be a dividend.
Dividends, great. And Brad, what else might you get if you own a share of stock?
Capital gains.
Say it again.
Capital gains.
Capital gains, good. Okay, so with the stock, we get dividends and we get capital gains. So how much are you going to pay for the stock? Well, you want to look at what your expected capital gains are, and you look at those dividends out into the future and discount them back to today. Well, how long should a company exist? Well, theoretically, it should exist forever. So you're figuring out what all of the future cash flows are forever. There's got to be a better way. So, and there is. There's some formulas that provide us a bit of a shortcut, and that's what we're going to work on a little bit tonight. Okay, so we've got this company, Big Day. They just paid a dividend of 50 cents. That would be dividend sub zero. That's the dividend today. So if we were looking at the company's stock price, that dividend's no longer part of the stock price. Once a company, let's say the stock was selling for $2.50 a share, if they pay a 50-cent dividend, you as the owner now have a share of stock that's worth $2, and you have a 50-cent dividend. So once the dividend is paid, the stock price drops as a result. Okay, so they paid a dividend of 50 cents. It's expected to increase its dividend by 2% per year. If the market requires a return of 15%, how much should the stock be selling for? Well, what you're doing for this problem is you are, come on, baby. You are, if it writes for me, you are. Okay, you're creating a timeline. Nice straight line. Okay, we have time period 0. That's why the nuns used to yell at me about my handwriting. 2, 3, and then dot, 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 and this is infinity, so that's forever. Okay, so we have a dividend of 50 cents right now. And next period, it's going to be 50 cents, and it's going to grow by 2%. So that's 50, is that 50.1? Let's presume it's 50.1. And the next year, it's going to grow by 2% more. So let's just pretend that's 50.2. Sorry, I'm not doing the math. Okay, and let's assume by infinity, the dividend might be up to, let's say it's $3 at this point. So to figure out what you'd pay for this share of stock, they don't tell us there's any capital gains. What they do tell us is that as an investor, based on how risky this stock is, I want to earn 15%. So I would take this first dividend of 50 cents and discount it back to today at 15% for 1 year. And the 50.2, discount it back at 15% for 2 years. And this discount it back to today. And I would do that every year forever. Okay. I could do that, but forever is a long time. And so what happens more frequently is we use the formula. And as we look at cash flows that occur way far out in time, their impact on the value of the asset's very small in today's dollars. It just amounts to not much at all. So what we use is a simplifying formula. And this is our formula. This formula says the price of the stock at any point in time is equal to the dividend next year divided by the required return minus the growth rate. So the price I'd pay for the stock today for Big D is equal to the dividend next year. And what's the dividend next year? Well, it's this year's dividend times 1 plus the 2% growth rate. Okay, so if I want to know what I'd pay for the stock, if I want to buy the stock today, I have to look at what the dividend is next year. I don't want to look at today's dividend because I've already received that and it's not part of the stock price. So the 50 cents times 1 plus the growth rate, which will be the dividend a year from now, and then divide that number by the required return of 15% minus the growth rate of 2%. When we do that, we see that for this stock with no expected capital gains, we would expect to pay $3.92 for this share. What questions do you have for me on that? Is that looking pretty normal? Okay, let's look at another one. That's nice, but what you typically see with companies is in the early years, they might grow at a faster rate with their dividends, and then they slow the growth down because stocks should exist forever. They cannot, in the long term, grow faster than the U.S. economy because then they surpass the U.S. economy and they ultimately become the U.S. economy. So what you'll often see is companies in their early days will pay dividends that are growing at a fast rate. We call that kind of supernormal growth. And then it slows down to a permanent growth rate forever. So we can figure out the value of that stock too. So here we have a stock that just paid a dividend of $2. So Matt, if they just paid a dividend of $2, that's a D sub what? Dividend in what year? Matt Ford.
Say that again. That's of what?
We just paid a dividend of $2. So that would be D sub what? What year is that occurring?
0.
Good. That's D sub 0. And we know if we're going to try to figure out this price, we're going to need to know the dividend a year or from now. But that formula that I showed you a moment ago only works when the stock price starts growing at a constant rate forever. So perpetuity is a key word here. So 3 years from now, we're going to be growing at a constant rate, but we've got fast growth in the short term. So what we have to do is, if the discount rate is 12%, we have to figure out our dividends each year. So we have a $2 dividend right now, growing at 8%. So that means my dividend in year 1 grows to $2.16. It's going to grow at that 8% for 3 years. So dividend in year 2 is at $2.16 times 1 plus the growth rate of 8% again. So my dividend in year 2 is $2.33. In year 3, it's still growing at a constant rate of 8%. So dividend in year 3 is $2.52. Now, in year 4, we start growing at a constant rate. The formula says whenever we start growing at a constant rate, I can find the price the year before. And we call that price a terminal value. And you'll see we're going to use this later. So my price in year 3 is equal to my dividend in year 4, which is the year 3 dividend of $2.52, growing at that constant rate of 4%, which grows to $2.62. So my price in year 3 is my dividend in year 4 of $2.62 divided by the required return of 12% minus the 4% growth rate to give me a terminal value of $32.75. Now look what we did. We have an asset that just paid us a dividend of $2. That's not part of the asset anymore. If we buy this asset, we're going to get $2.16 in year 1. We're going to get $2.33 in year 2. We're going to get $2.52 in year 3. And also in year 3, we're going to have this terminal value of $32.75, which covers the value of the dividend in year 4, 5, 6, 7 to infinity. So I have everything I need to figure out how to price this stock. So look what we're going to do. We put it on a timeline. If you put this in Excel, we've got this cash flow stream with this stream of cash flows. Remember this $2, we've already been paid that. So this is no longer part of the value of the stock. That's an asset that we have in our hand. Instead, what we have is $2.16 that's going to need to be discounted back for 1 year. We have $2.33 discounted back for 2 years. And then we have the dividend of 252 that's still at 8% growth, plus the 32.75 that we're going to get for a terminal value. So we have this cash flow of 35.27 discounted back for 3 years at the 12% rate, I think. Let me just make sure I've got the rate right so I don't confuse you more than you already are. Let's see. Come on, pop back. Yeah, the 12% growth rate. So to value a share of stock, you need to figure out its dividend each year before it's growing at a perpetual rate, and then figure out a terminal value for when it starts growing at a perpetual rate to come up with the overall value of the stock. All of that is incorporated into the stock price. Those are just the formulas to get there. So we had to figure out the price. We have the 216 cash flow in year 1, the dividend the first year, 233 in year 2, and then in year 3 we have the dividend we could get in year 3 plus that terminal value, and we're just computing an NPV based on the discount rate of 12%. So these are the different formulas that are really important. Stocks are easy once you do a few of them. So if you have no growth, a no growth stock we did earlier in chapter 4, I think. If there's no growth, it's just the dividend divided by the required return. That's how you also value a share of preferred stock. It's just whatever the dividend is. So if the dividend were $1 and the required return is 12%, it's $1 divided by 12% to figure out what you'd pay for the share of stock. The formula we use most often is for a company that's paying a dividend that grows at a constant rate forever beginning next period. That's the dividend in year 1, and pay attention to these subscripts. Dividend in year 1 divided by the required return minus the growth rate gives me the price in year 0. That's the general formula. That's the 1-year formula. This is the general formula, and this is important because if you have supernormal growth for a couple of years, it means I need to find the price in the problem we just did in year 3 because the dividend started growing at a constant rate in year 4. Now, you can rearrange this formula and you can figure out where your price is coming from. So I can rearrange to find how did I get that 12% required return. It's based on the dividend yield of the dividend divided by the price plus that growth rate. Oops, sorry. Back up one. So this tells us what we can expect in terms of a required return. Now take a minute before I ask you to do, well, first of all, what questions do you have? That look sort of normal? What I would suggest before you get into your breakouts is to write down, this is the general formula, so I would write down this one, and I'd also write down this one, the required return equals the dividend yield plus the growth rate, because you're probably going to use those in the rooms. And I'm intentionally, I did too. It's really easy to sit and listen to me do them and not realize what's confusing to you. So it's easier to do a problem in a small group than it is to have me just keep going through them because it's hard to focus when I'm just droning on. So this is the problem I want you to do. I'm sorry I didn't send them to you earlier. I should have. So write this one down. So we're trying to find a current price, and then we want to know the price in 3 years and the price in 15 years. And I want you to think about how you're going to do that. If you know the price today, what would you be willing to pay for it 3 years from now and 15 years from now? So I'm going to I'll put you in breakout rooms, and I'll open them up. Let's just do 3 rooms so you have a little bit more, a few more people in the rooms. I'm opening the rooms. As soon as you've got the problem written down, go ahead and pop into your room and work a little bit, and then we'll come back together and see how you did. You had enough time to talk it out. You're just not sure you've got the right answer. Okay.
Yeah.
Can I ask you a question?
We've helped a little bit.
Say it again, Brad.
Can I ask you a question going back to what you initially said with the growth stock dividends?
Sure.
Don't growth stocks typically not pay dividends because they reinvest that money into the stock itself to grow the company?
Exactly right. Yeah,
So-
so we do a different valuation model for them.
Okay, got it. That's just where I got
Yeah.
caught up a little bit because in
Yeah.
my head I was thinking that once they stop growing, once they reach that, once they peaked
Yeah.
essentially.
There's a different way. We do some ratios, and we look at some competitor firms to value those stocks to project out what the growth will continue to be going forward. Yeah, yeah. This is the way we used to always value stocks, because most companies pay dividends back in the day. Well, they don't really pay them anymore, but we still learn this technique because there are some stocks that pay dividends. But more importantly, when we're valuing a company project, up until now, every project we've looked at, we've assumed it stopped after 3 years or 5 years. What we'll see when we get to chapter 11 is the projects often go for 10 or 20 years, and we're not going to do 10 or 20 years of pro formas. Picture that problem 10 at the end of chapter 10, doing 20 years of that. We don't do that. Instead, we usually value it for about 5 years and then calculate a terminal value. So we use this formula all the time in valuations, but not necessarily to value a company stock all that often. It just doesn't apply to a lot of companies. Okay.
Thank you.
Okay. All right. Who would like to tell us how they started this problem? Response is overwhelming. Okay, Mike Gallagher, go ahead and give us a run on what you did.
I was actually a little confused with this one, but my team has it, if that's helpful.
Okay. So tell us what your team did.
So I think we just put out a timeline, like from year 0 all the way through 16.
Okay.
Because I think it wanted us to calculate up to the price in year 15.
Yep. So what did you get for the price today?
For the current price, $31.35.
Yay. And what'd you get for year 3?
$35.78.
And year 15?
60.67.
Great, man. Okay, tell us how you did that.
So you start with doing the timeline. You start year 0, the dividend was $1.95, which was given, and then it grows at a rate of 4.5%. So you just kind of do that calculation. So year 1, the dividend was $2.04, year 2, $2.13, etc. And then you just use for each price, you use the formula of the next year's dividend. So for the current price, the next year would be year 1, and the dividend was 2.04. And you divide that by the required rate of return of 11% minus 4.5%, which was the growth rate.
Okay.
And then for the price in year 3, you need to identify what the dividend in year 4 is, which was 2.33. So you divide that by, again, 11% minus 4.5%. And then same thing for year 15. You need to figure out the dividend in year 16, which was 3.94. And then you divide that by the same 11 minus 4.5.
Good. Okay. And when you did when you found the price in year 15, how did you find the price? Oh, okay. You stopped at year 15. Okay. Got it. Yep. Got it. Okay. So what Matt did is he used the standard formula of the price in year 0, the price in year n equals the dividend in year n plus 1 divided by r minus g. He used that formula over and over. So he did it for year 0. And in year 0, the price in year 1 is $1.95 times 1 plus the 4.5% growth rate divided by the 11% minus 0.045 to come up with this $31.35. And then what he did to find the price in year 3 is he figured out what the dividend was in year 4. So he took this $1.95 and had it grow at 4.5% for year 1, year 2, year 3, year 4. That gave him the dividend in year 4, which would give him the price in year 3 divided by 11% minus 0.045. And then he did the same thing in year 15. He found the price in year 16 divided by the required return minus the growth rate. And that's perfectly fine. An alternative would be in year 0, use the formula just like Mike did, okay, to come up with this $31.35. In year 3, if we know that the price in year 0 is $31.35, We also know that that's a present value that's going to grow at 4.5% for 3 years to find the future value of the price in year 3, which gives us the same 35.78. And in year 15, we take the price in year 0 of 31.35, multiply it by the 4.5% for 15 years to get to the 60.67. So, excuse me. So either way is correct. You can either use the pricing, the generic version of the pricing formula to figure out what the dividend is a year out to find the price in year 3, find the price in year 15, or you can calculate a future value. Does anybody have any questions about this particular problem? Feeling pretty good about that one? Okay, let's take a look at another one. Oops. All right, now this is one where you have to find the required return. Remember, the required return is equal to the dividend in year 1 divided by the price plus that growth rate. So look at this for a minute, and once you have the numbers down, oh, you know what? Why don't we take a break? And so I'll put you in your rooms, but I'll leave this problem up so you have a chance to write it down. It's 5 of. Let's come on back at 5 after and head right into your break rooms or to your breakout rooms at 5 after. I'll give you a couple of minutes before I pull you back in together. Okay, your room should be open now. And we'll do this one when we get back from break. Rebecca, tell us what you did.
Okay. So I kind of went old school a little bit and I said solve for X. So I did 2.9 times 1.055 divided by X minus 0.055. So I solved for it. And equals 53.10. So the 2.9 times 1.055 is 3.0595 divided by X. And then I just said equals 53.10x minus the 2.9205, which is the 53.1 times 0.055. And I added the 3.5 to the 2.92 and then divided that by 53.10 to get x, and I got 11.26 as the required rate of return.
I'm with you on everything except I got 10.96. Did anybody else get a different answer, 10.96 or 11.26?
I think it was because, Rebecca, you grew 2.9, but it said it was 2.9 was next year's per share. So I don't think we needed to grow that again, right? Because that was already implied.
That's exactly right. The dividend in the problem, the dividends is it'll be 290 next year, which is dividend in year 1. So that's why you didn't need to grow it. You got that, Rebecca?
When our group, I have a question. When our group did the other formula where you do 290 divided by 5310, and then you add that to 5.5, we got 11.0. Oh, never mind. It's rounding.
Oh, it's rounding. Yeah. Okay.
But you should always go out to 2 decimal places.
Yeah, you should just to avoid rounding errors. Okay, Rebecca, do you see why we use 2.9 instead of 2.9 times 1 plus the growth rate?
And then you divided that by 53.1?
Yeah, so here's the formula. You were perfectly fine the way you did it. You just used, you just solved for X, you used algebra. But this is the formula, and all it is reallocating, just rearranging the formula. So the required return is equal to the dividend yield, which is dividend in year 1 divided by the current price plus the growth rate. And when we do that, it was just as you said, except you put a growth rate in here. So 2.9 is next year's dividend year 1 divided by the price today of 53.10 plus that growth rate of 5.5% gives me a required return of 10.96%.
Still getting 11.011.
Yeah, the reason you're getting that is you don't have your cell formatted properly. So if you go in and format it as a percentage, and
no, I did. It's still coming up as 11.
Is your numerator here 2.9 or 2.9 times 1 plus 0.055?
No, it's 2.9.
Okay, check your math. It sounds like you're doing everything right. But check
It
your
might be the
math.
decimal places.
Yeah, it could be decimals.
What about this calculator? Because I got 11 exactly, and actually it messed me up on the last problem. I couldn't figure out why I was not getting 31.35, but that's because this business calculator, the BA2 Plus, only goes 2 decimal places. So
No, it
I was
doesn't.
dividing.
No, it doesn't. You've got to fix it so that you've got to format it. And oh shoot, I don't have my calculator in front of me. I think it's function button, and then you see above one of the keys down towards the bottom right, sort of it says format. Yeah, hit the function format and put in a 4 and save that, and then you'll have enough decimal places.
Okay.
Try it again and see if you get the right answer, Tom. Yeah, darn
Can't find the
BA2 Plus.
function button.
It's the bottom left, I think, right down in the corner. I think that's where it is on the calculator.
Function?
If not,
I see format.
Oh, yeah.
But I just can't.
Yeah, or second level button or something.
Oh, second.
Second. Try that.
Ah, there we go.
Did you get 4 and then save that in there? So you save 4 spots. Now, if you do it, you should come up with the right answer.
There we go.
Okay, so when we do this 10.96%, that's the required return. What's the split between dividend yield and capital gains for this one? Adam?
I got 5.46 for the capital gains yield. 5.46%.
It's the opposite. 5.46 is the dividend yield, and the capital gains is the 5.5.
Okay.
The growth. Okay. So when we think about yield, the dividend yield is the percentage of my return that comes from dividend. That's this part of the formula. And then when I think about my capital gains, that's growth. So that's the G. So yeah, you're exactly right. You just had the names of them reversed. So when we look at that, so when we look from our formula, the dividend yield is the dividend next year divided by the price, and the capital gains is just the growth yield. Everybody good on that one? How we did required returns? Okay, let's I'm going to pop you in your rooms again. Okay, now first I want you to think about this one. Don't forget what we learned in earlier chapters. Can you use our new dividend formula for this problem?
Wait, I don't understand the 5.46.
Okay, let's back up. Hold on. The 5.46 is, that's the dividend yield. So if we look at the problem, where I have it. Okay, so when we look at this problem, to solve for my required return, if we don't use the X like you had done, it's the dividend yield, which is the dividend in time period 1 divided by the current price. So that would be the 290 divided by the 5310, and that comes out to be 5.46%. That's the percentage of my return that's required that's coming from dividend. The rest of it is coming from growth of the dividend, but it's growth. So the capital gains part is the 5.5, the growth. So if you come in here and do the 2.9 divided by 5310, you should get 5.46 if you have enough decimal places in there.
Okay.
Okay. Everybody clear on this problem? Thanks for asking, Rebecca. Everybody good on how we finish this one? Okay. And it is, you can always solve this problem the way Rebecca did. She just took the regular price formula that we had earlier and just solved, and that's perfectly fine as well. It's a little easier to use the formula because it splits out those two pieces, the dividend yield and the growth component. Okay, we just did that. Okay, Now look at this problem for a minute and think about how you're going to approach this before I pop you in your rooms. Somebody tell me what you think you're going to do on this one. Let's see who haven't I. Jake, how are you going to approach this problem?
I'm not sure.
Still thinking? Okay. Let's see. Okay, Ben, what are you going to do?
Would it be to use the NPV formula from Excel?
Good. Don't forget that just because they call it a dividend, you don't immediately have to go to the dividend formula. The dividend formula presumes we have constant growth forever. If we don't have constant growth forever, that formula doesn't work. So look what this is. It's going to pay a constant $9 per year for 13 years. The required return is 9.5%. Isn't that just a payment problem? So it's $9 payment for 13 years, or as Ben said, just use the NPV formula, which works perfectly as well. Okay, so just because it says dividends, you can only use that dividend formula if you have constant dividends forever. If you don't see forever, perpetuity, or indefinitely, then you can't use that formula. It only works if dividends grow forever. So I'll pop you in your rooms. You should be able to do this one pretty quickly. Okay, Mallory, what'd you do on this one?
So we used the present value formula. So we just did equals PV, the rate of 9.5%, number of periods was 13, and the payment was $9.
What'd you get?
And that gave us 65.62.
Good. And as Ben said, he was going to do an NPV. You can do an NPV on this one. That's fine. NPV typically implies that you're netting out an initial outlay. There's no initial outlay here, so you would get the same answer if you did this as an NPV or you did it as a present value. And as Mallory noted, you have a payment of 9, no future value on this one. You have N of 13. Your interest rate is 9.5%, and you're solving for present value, and you should have gotten 65.62. So given the fact that this company is only going to pay dividends for 13 years, we don't have any anticipated growth at all, just 13 years of dividends, we would be willing to pay 65.62 for that income stream. Everybody good with that one? So remember, with pretty much any problem, because once you leave this class, you're going to be presented with problems that you're going to need to figure out what they're worth in today's dollars. Ignore the words about dividend or stock valuation. Look at what the cash flow is and when's it occurring. Think about this in terms of your timelines, and then know that you can't use a dividend growth formula if you're not growing forever. And you can refer back to these standard present value formulas all the time. They really are used very, very frequently in most organizations. Okay, let's take a look at this next one. Now think of this in terms of your timeline. So they're going to pay nothing for 9 years, and then $17.50 that's going to grow at a constant rate. Okay, so you're going to be able to figure out the price sometime out in the future, but then you want to know what you pay for it today. So then you're going to need a 2-step process for this one. I'm going to open up your room so that you can get in whenever you're ready after you've written down the problem. And then I'll pull you back together. This is a good problem.